Hello everyone, this is Kirk here again at optionalpha.com and welcome back to the recap video here today for January 16th, Thursday. As always with the video recap, this is just for members, and those of you who are viewing it publicly on YouTube will get this video about 5 to 7 days after it goes out to just our members. So you can't take advantage of any of the new trades that we put on. Obviously, those are just for members. So let's go over some of the trades that we made today. It was actually a pretty fair day as far as the disbursement of trades. Had some closing trades that we started to take off here as we get at the end of expiration, and then also some new opening trades with some really good implied volatility levels. And then finally, a Twitter vertical roll to the next contract month. So I want to go over that one specifically at the end of the video. So first, let's cover the couple closing trades that we had, and I'll go over just one of them in the charts and then just kind of quickly run through the other ones. But they're all buying back vertical spreads that we had. The one that we bought back pretty good for a nice little profit was JCPenney. This one was actually a February trade. You see that we sold the 9-10 call spread, and we sold it for a little over 33 cents, something like that, or 28 cents, and we bought it back today for 5 cents as a debit. Took in a $23 profit, but the reason that we bought it back so early is, again, because of our strategy and our system, is that if we sell these call spreads and they make the vast majority of the profit that we could potentially make on them, there's no reason to keep the position open and going all the way through February. So implied volatility is now at the 36th percentile since we entered the trade. And again, we had the 9-10 call spread. So and just hold this position all the way through February expiration, possibly have the market turn around, JCPenney start to rally, implied volatility go up, whatever the case is. We had a great opportunity to take some profits, and that's what we need to do with these types of trades. Take the money off the table. Okay, so the other two trades that we closed out today was the two call spreads, or the call spread and the put spread on Dow. One was a hedge that we had put on originally to get some extra premium. And so we took a $37 loss on the call spread and a $4 profit on the put spread. So at the end of the day, is a very minimal trade as far as profit and loss. But again, Dow was all over the place. So we're trying to take advantage of implied volatility, but just couldn't really get it to happen. It was kind of jumping all over the place near the end of expiration. All right, so new trades that we put on here today. Pandora P was another really good one. We traded Pandora a number of times back in December and November of last year, and so coming again back to the well and trading the vertical call spread in Pandora. I actually made a little bit wider of a spread here just to take advantage of what good volume we had in Pandora today, and we traded the 38.40 call spread, and we did that for 56 cents in credit. So again, instead of doing the 38.39, where we could have gotten about 30 cents in credit, we just made a little bit wider, took in almost double the credit that we would have taken in if we had just done the $1 wide strike. But again, the whole story here with any of these trades that we do on the call side with vertical spreads is that implied volatility is really, really high. And so you'll see that Pandora has just been running straight up ever since kind of the beginning of 2013. So that's why we decided to go on the call side of the market and play the bearish move possibly in Pandora as we head into February and earnings. But also implied volatility is at the 59th percentile. So you can see that up here in the left-hand corner of our screen. And so with implied volatility this high, we don't want to be doing any type of strategy that takes advantage of buying options. We want to be a net seller of options. So that's what we're doing in this case. We move on to the other trade that we made, which was UNG. So UNG was actually pretty interesting, and we've tried to trade this a little bit here in January and didn't have a lot of success with it, but we're going to go back to the well again here with UNG because implied volatility is at the 100th percentile. And you really don't ever see this with a lot of stocks. Maybe once or twice a year during the year do you see a stock that has 100% implied volatility baked into the pricing. So with that, it's just too good of an opportunity to pass up. So we sold the 2019 put spread. We took in a 23-cent credit on it, and I think that's a pretty good trade. We moved a little bit further away from the market because it's just moving all over the place, and you'll see how sporadic UNG has been just in the past couple weeks. So because of that, we decided to move a little bit further from the market and give ourselves room between us and the market. But you'll notice up here in the top left-hand corner of the screen that implied volatility is at the 100th percentile. And so what that means is that option premiums are extremely swelled. They're practically as swelled as they can possibly be. So any type of strategy that takes advantage of selling premium, whether that's strangles, iron condors, credit spreads, butterflies, etc., those are the good types of trades in here. So the reason that we didn't go with the strangle is just because the pricing was not that favorable on the strangles. It didn't get us far enough away from the market, given the fact that UNG has been moving so rapidly in either direction. So when I do a strangle, I usually like to get a couple dollars away from the market and kind of widen out those spreads. But even with a strangle, you really couldn't get too far away from the market with your break-even prices. So we decided to play it a little bit more conservative and go with the credit spread. But that also leaves us opportunity to then add another credit spread above the market on the call side if this continues to run up. So we're doing a small position now, knowing that we have an opportunity to add to this position in the coming days and weeks if UNG continues to move rapidly and implied volatility stays high. All right, so the last one I want to go over and spend a little bit more time on is the role in Twitter. So Twitter is a little bit interesting. We've had a fairly good month trading Twitter and have been very nimble in our exits in Twitter. And today, as we come up on January expiration, we had a 62.5 60 put spread that we had sold originally that was very marginal. And again, you'll see it today with Twitter pricing is that we're right on the cusp of being a very profitable trade or losing trade. And so rather than let this thing roll the dice and go all the way through expiration tomorrow, what we decided to do was to roll the contract over to the next month. So give ourselves a little bit more time to be right and add some duration to the trade. Duration means just more time to the trade. And here's the key with all of these rolls. And so again, we rolled the Twitter to February. So we had a new opening sell from February and we closed out the January. Same strikes. So we're working in the same strikes. But here's the key to this roll, and really all rolls that you do with any type of credit spread, is that you have to take in some sort of extra credit on the roll. So by rolling to February, because we're extending our time period and our investment in this trade, we also extended the amount of credit or increased the amount of credit that we received. And I typically like to say this because usually if you're going to pay to roll, then you might as well just reset your strikes, right? If you're going to pay $20, 20 cents, or 25 cents to roll, and you originally sold it for 30 cents or 35 cents, there's no point in rolling for a payment. You might as well just reset your strikes at the new month. But at this point, with February and January expiration happening and the pricing working out the way it did, we actually were able to roll this contract, close out January, reopen a new position in February, and take in a little bit more premium than we originally had. So basically all we're doing here is extending our time and extending the amount of credit that we have, giving ourselves a little bit more time to be right. And I'd like to do this only when stocks are right around our strike prices. And I've said this a couple times before, TWTR. I've said this before a couple times in video tutorials, but again, you'll notice that Twitter is just kind of right up there, and it was bouncing up above 62 today. So because of that, it's right around our strike prices, and that's what we want to see. We want to see this thing right around our strike prices to be able to roll to the next month. If Twitter was all the way down here in the 50s, there's no point in doing this. Same thing, if it's all the way up here around 70, no point in rolling your contracts. I see too many traders do that when it doesn't make sense at all. It's not even close. But when the market is right around your strike prices, kind of flirting with your strike price as you get towards expiration, then it's a good idea to actually roll that contract out. Now, the last point I want to make about the roll is that it's important that your implied volatility continues to stay high. So again, if you have a contract that you have on in January and you're considering rolling to February, take a look at where implied volatility is now and ask yourself the question, would I enter that trade new if it were just a new trade in February? And so the answer today with this trade is, yeah, I would enter that trade today because implied volatility is high. So I'd still be selling premium in February given that implied volatility is at the 80th percentile. So that's another key point about rolls that most people don't understand is that you have to make sure that you're still trading the same side of volatility. It's not just enough to take in credit. You have to still be on the right side of that volatility movement, okay? So I think this is going to be a good trade and hopefully it'll work out. And obviously we're giving ourselves more time to be right on Twitter, and that's all we can do in this market. Give yourself enough time for the probabilities to work themselves out and you'll end up very, very profitable in this business. So I hope you guys liked this video. Hopefully it was helpful, especially with rolls. We don't roll that often, but this is a really good example of rolling. As always, please ask your questions down below in the comment section. I'll get back to all of those questions later today or tomorrow, and happy trading.